It's time now for the Gem Young Wealthcast. Brought to you by Gem Young Insurance and Wealth Advisors, a family-owned independent insurance and financial planning agency since 1947. Now, from their studio on Star Center Drive in Canfield, Ohio, here's the host of your program, Leo Daprile.
Welcome to the Gem Young Podcast. We are now a video podcast. If you're just joining us today, we are in our second series of our Analyst Roundtable, having one of my absolute favorites. Excuse me. Hello, Glenn. Good to see you today.
Hey, good morning, Leo. Happy New Year.
Happy New Year to you, too. Well, Glenn Dorsey is the Senior Vice President of Portfolio Management at Clark Capital Management Group, for those of you that are new to this podcast series. He always offers very insightful perspectives of what's gone on in the market. He has an uncanny ability to be right most of the time, which is very difficult to do in this business, but he seems to pull it off. In the past, Glenn and I have been accused of living on Optimist Island, and fortunately, we've been right on that. That's served our clients well. So there's been a lot going on in the past year, and we had a year that was much better than I think anybody anticipated. And it's funny, Glenn, one of the things we heard, one of the things I heard all through last year was, okay, it's near the top. It's near the top. Should I pull back? Should I pull back? And we stayed true to our disciplines. We didn't react to that feeling. And you and I know well that sometimes feelings are dangerous when it comes to how your clients, our clients, want their money managed. And our job is to kind of help guide them around those feelings at times. So let's start by saying, what was your biggest surprises maybe in the fourth quarter of this year, and some of the areas where you thought were quite successful?
Well, I think from maybe a surprise standpoint is the Federal Reserve finally started to reengage. Right? We got 3 cuts in the fourth quarter after having not done anything during the year. You could have built a case for either action, that they did nothing or that they started to cut. So it was a little unusual. They cut by 100 basis points in the fourth quarter of 2024. And then, as I said, basically took 9 months off in terms of doing anything, and then sprung back into action to lower rates. So that was a positive surprise for the market. I think things that went right, earnings. I mean, that was really very, very important. I think the consumer continued to be resilient, which is something that everybody has underestimated. The effect of tariffs was going to cause hyperinflation, was going to cause a recession, and it just didn't happen. The consumers continue to spend money, and as we always say, as long as folks have jobs, they're spending money. Right? We're exceptionally good at that, and we've seen that over and over. We saw it in 22, 23, when everyone thought there was going to be a recession, and you and I didn't. And that was because of the strength of the consumer and the strength of the labor market, which has softened a little bit, but is still pretty solid.
So I'm seeing that about the labor market, and quite honestly, that's a bit refreshing to me, because that tells me we're not running towards that exuberance in the overheated economy, and that there's pockets that are beginning to show some weakness, which, as weird as this sounds, I think that's healthy, because it brings things back to moderation. And we're starting to see that, at least, and I'll say this from my little part of the world, Glenn, that, hiring at the end of the year, I was amazed, because we use a service that we have a philosophy here, what we call always on recruiting, which means we're always looking for good talent. So even if we're not hiring, we're always looking. And I was quite surprised how many resumes we received in the last 3 weeks of the year that I haven't had for 2 years. So I'm starting to see maybe some dissatisfaction with people in their jobs. Maybe there was more layoffs coming. And I think a lot of the folks, when we talked about this maybe a little bit in the past, that during the hiring craze of the pandemic, a lot of people were commanding much higher wages to switch jobs, and they got it. But we're finding those are the first ones to be laid off, because now they're looking expensive. So I say that in terms of a moderation of the employment practices coming in, and we're out of that exuberant stage. So, because I, like you, I don't know about you, but I was surprised that we got a 100 basis point cut in the fourth quarter with the Federal Reserve. I didn't think they would go that far with it. But that tells me they were worried about some more things, some more underlying factors. And the only real trigger, in my opinion, was the softening unemployment. Trying to, as we've talked about many times in the past, that's one of their dual mandates. The inflation still kind of nagging them, which is one compelling reason to not reduce the rates, but the increase in the unemployment, I think, became probably a greater issue. What do you think about that, buddy?
Yeah, yeah, you're right. I mean, they have a dual mandate, and they're competing against one another. Right? Trying to keep full employment always runs the risk of creating inflation by overstimulating the economy. And so they went from focusing on prices, the other part of their dual mandate, the inflation, and they have done a credible job of bringing it down. We were at CPI at 9.1%. We're down to 2.6% core, not at the 2% level, which frankly is arbitrary. They picked 2% out of the air when inflation was running below that and said, over the long haul, we'd like inflation to be around 2%. And as soon as we crossed above that, then they panicked and hit the button and started to raise rates pretty dramatically. So I think when they look at the balance of risks right now, inflation is moving the right direction. And arguably, I think a lot of the inflation that was created was COVID-related, shutdown of supply. Government made some mistakes in terms of overstimulating the economy, which created the inflation. But inflation's been trending down and unemployment's been trending up, right? So we've gone from 3.4%, I think was the low point on unemployment. We're back, 4.6 now, I think. And what we're seeing is it is a kind of a hireless and fireless economy, right? We haven't seen a significant pickup in layoffs. And I know if you watch, the news, you hear every layoff that happens. But when you look at it on a national level, it's been pretty flat at about 1%, the layoff number. What has trended down dramatically is the hire rate, right? So companies I would say it's a hiring freeze, but it's pretty close. I think part of it's uncertainty around tariffs. Some companies are obviously impacted. They want to see how this all plays out because it's been a moving target in terms of what the tariffs are going to be and what the lasting impact's going to be. But I also think that companies are looking towards AI to take over some tasks that are not manual in nature, but kind of service oriented, where they can replace people with technology. Before automation, took people off the assembly line. Now it's taking people out of the service industry. It's a different automation than we're having now. So I think you're right. The balance of power has changed. We went from 2 job openings for every available worker to 1. And so that ability to bounce jobs and get a 15-20% raise, that's gone. It's a pretty balanced labor market right now. The labor force is not growing that much anymore with some of the immigration policies and things like that. We're not seeing the same growth in the available workers. So we would expect the numbers to slow. The new job creation numbers should probably slow.
So here's another question and debate I'm asking everybody, and you brought it up, so thanks for teeing the next question up for me. Inflation, the arbitrary 2%. What's wrong with 3? Why do we have to get to 2?
I've made this argument for a while. If you go back and look at the 80s and 90s, 2 very good decades for stocks, for bonds, for short-term investments as well, inflation ran 3 to 5% over that 20-year period of time. So I think you need some inflation it's healthy for an economy. You want some inflation. I think being laser focused on 2% is, like I said, it's kind of arbitrary, unnecessary. I'm fine with 3%. If we can get, S&P up 18% and have 3% inflation, I'll take that trade all day long.
That's right.
So, I think we're in the zone where the Fed realizes that the inflation problem is by and large taken care of. And go back to the root cause of what it was, right? If you think about inflation, or prices are set by the intersection of supply and demand. Like during COVID, we stopped making things. And then the government, through stimulus checks and other measures, pumped trillions of dollars into the economy, we saw money supply grow over 20% at a time that we had the lowest production that we've had in a long time. So if you have that much money available to spend and you're not producing as much, clearly you're going to have inflation. Chairman Powell was correct when he said that the inflation was transitory, right? Meaning, because he knew what caused it. He's a smart fellow. But I think where it was a little mismessaged was how long transitory meant, right? And we've been, I had contended whether the Fed did anything with rates or not, we would have seen inflation drip back down again because, the supply chain was improving, the stimulus money was being spent, you're having more of a balance between supply and demand.
And even where we sit with all the rate cuts that we've had, we're still at a very healthy rate that, when we have the need for rate cuts in a decelerating economy and the risk of inflation potentially because of more spending because of lower rates, that really hasn't played out. So even though the buyer, the consumer is still consuming, they're not getting ridiculous or euphoric because of this.
Yeah, the lower bound of the Fed funds rate is 3.5% right now. So there's plenty of room to cut if the economy needs to be stimulated. But the reality is it hasn't needed it, right? We've been on a good trajectory other than the first quarter of this year where we had a negative 0.6% GDP, which was completely induced by people trying to beat the tariffs, right? So we saw a huge surge in imports, which is obviously a drag on the domestic economy. But since that time, we've stabilized, and third quarter GDP was 4.3%. That's a good, healthy level. It's not over exuberant. It's good, solid level. We're seeing kind of some cracks in the lower bands of creditworthiness in terms of delinquency starting to kick up. So I don't think we get to a point where that it will get over exuberant and create inflation. As long as supply is there to meet demand, that's going to keep inflation in check.
So the lower grade consumer credit, are you referring to credit card debt essentially, or is it home mortgages, cars, all of those things?
It's all of it. If you look at kind of a breakdown, about 60% of borrowers are prime, about 20% are near prime, and 20% are subprime. Subprime delinquency rates for credit cards and for autos are about 16% or so right now. So they've had a significant move up. All of the delinquency rates went down after COVID because of all the stimulus money that came in. People paid down credit cards and they were staying on top, and then went right back to their old bad habits of accumulating debt and debt that they couldn't pay. So, they refer to as this K-shaped recovery where the upper income is doing well and lower income is not. And that's true to a large degree. But so that gives you opportunity in the markets, right? To stay away from the buy now, pay later type of goods and stay focused on kind of the, higher end retail goods or those consumers, the prime rated borrowers, delinquency rates continue to be low, right? Less than 1%, almost zero on autos and a little over 1% on credit cards, which is, somebody just forgot to make a payment probably.
Right. So let me ask it in these terms without a product endorsement, but I'm going to use one of your investment solutions as an analysis. Okay. Let's take the fixed income total return, one of your products, and it's essentially a tactically based bond portfolio where you can and I'm saying this for the benefit of the listeners, the product, is you can shift between cash, high yield bonds, and corporate bonds. And I'm bringing this up because you brought in the increase in the delinquency rate of subprime, which a lot of times that are the high yield bonds in some cases where that money gets sold off to. Is that becoming an indicator for you guys? Is it making you look harder at your strategy because of those delinquency rate increases? Are you becoming, and we can make this also a broader bond conversation too, where we're talking about, because I know we always, sometimes in our conversations, you want to talk about bonds, and I sometimes treat it as the ugly stepchild, and there's only 5 minutes left to talk about it. So we're going to flip it and talk bonds first, okay? So as you're looking at these numbers, how are that filtering down to how you're managing your investment solutions?
Yeah, it's a great question, but interestingly, the delinquencies are really at the consumer level. When you look at corporate high yield debt, right? There's so treasuries, if you consider treasuries risk-free, and then investment grade corporations are going to pay a little bit higher rate than the treasury theoretically, and then non-investment grade are going to pay a little bit more. That spread between what the non-investment grade and treasuries are is tight right now. And that's because delinquencies have been very low at the corporate level. Where it has shown up more is in the private credit side, not in the public debt side. So we haven't seen any indicators yet that are concerning to us about non-investment grade corporate bonds, which also then has some ripple effects for the equity market too, because stress often shows up in the bond market first, and it's a warning sign that there could be a deterioration in economic conditions or earnings, and we just haven't seen that yet. The spreads remain pretty close to all-time tights.
Okay. So overall, you were saying for a couple of years, if you're in another conversation we've had is up until 2 years ago, being a balanced investor was almost a punishment, right? Because they're earning so little on their bonds, even though their equity part of their portfolios were performing, their overall rate of return was painful, quite frankly, because their return versus maybe somebody, and for reference, if you look at the world in terms of a risk grid of 1 super conservative, 6 super aggressive, I'm talking about the investor that was maybe more in the 3-4 range, where they were having the higher equity positions and owning bonds was almost punitive. But in the last couple of years, and you've said this, Phil Blancato said the same thing, stay patient. The bond market will hit some more normalization. You both were right on this. And the balanced portfolios have come way back. They're now making sense. People are being appropriately rewarded for the risks they haven't taken by being more aggressive and being more true to the risk profile. So where do you see the bond market? Well, 2 questions. How well did we do in 25, and what's your outlook for 26?
The aggregate bond index was up about 7.3% in 2025, so it's still behind the 18% that you got in the equity market, but both of them are sort of above what the longer term average returns have been in 2025. So stocks did a little bit better, depending upon the time period you pick for long term, you said call it 12%, 10 to 12% for the stock market. Bonds are typically in that 5% type area. So we did a little bit better than that. We saw the yield on the 10-year treasury go from 4.58% at the beginning of the year to 4.18% by the end of the year, so down 40 basis points. So that created that extra bump over the coupon, right? Because now the price goes up as interest rates go down. So if you look at the potential return for bonds, it's always the starting yield is a really good place to start. If you go back to when bonds were painful to own, the yield on the 10-year treasury got down to almost 0.5%, right? There was no return there, right? And that's when you remember the term TINA, there is no alternative. People just were forced out of bonds to go into stocks to get some kind of a return because you could make more on a dividend yield than you could on stocks. That's not the case anymore, right? So now you have a 10-year treasury above 4%. You have the yield on the S&P 500 dividend yield below 2%. So bonds now have a spot in a portfolio, right? And that if your starting point is a little better than 4% for treasuries, puts it near 5% for investment grade, and puts it up in the high 6s for non-investment grade. That's not a bad starting point. And if we get a little tailwind from rates going down, returns could be that or maybe even a little bit better in the bond market for 26.
Do you see the Fed making any changes in 26? And do you think they need to?
It's another great question. The Fed sees 2. The market sees 3 cuts in 2026. Historically, both have been wrong. If you go back at the beginning of the year and look at what was expected and then what happened, they both are wrong. I still feel that the Fed is in a position that they can kind of do whatever they want. Inflation is going to continue to drift down because if you look at the major components of what drove inflation, housing, car insurance, things like that, and car prices, they're all drifting down, right? Not because of where the Fed is. So I think inflation is moving the right direction no matter what they do. I think, and I don't think we're on the brink of a recession. Right? So I think that they have the luxury of probably tapping their toes a little bit before they need to do anything. If you look at the Fed funds futures market, it's expecting the first cut to be in April. Right? We have a meeting at the end of this month, and about a 15% chance of a cut at that meeting. I wouldn't be surprised if they waited a little bit longer than that. But we do have a lot in play. We have everybody knows that Chair Powell's term's up May 15th. Then we're going to get a new head of the Federal Reserve, who obviously is going to be likely to be more dovish, and because President Trump's been pretty vocal about wanting lower rates, so whoever he appoints is likely to want lower rates. But there were 4 other members that changed at the beginning of this month that are voting members of the Fed, 3 of whom are arguably more hawkish and less likely to cut rates, and 1 is a little bit more dovish. So, you could hit a point where there's a little bit of let's sit back and see what happens. And, we're going to have a decision on the tariffs, likely pretty soon too. I don't think the Fed's in any rush or needs to be in any rush to do anything. That being said, if I look at the balance of risks, I think there's more risk to the labor market weakening than inflation coming back. So I think the bias should be to lower rates.
So I know we've all heard this, that President Trump's been pushing for lower rates. Where does he want them to go with it?
I think if he had his wish, it'd be 0, because it's going to stimulate the economy. And, I don't know any president in modern times when inflation hasn't been an issue that didn't want lower rates, because it's going to stimulate the economy. It's going to make them look like they're doing a better job at what they're doing. Right. So he's pretty, as we said, very vocal about lower rates. I don't think he sees much of a lower bound in terms of what he would like to happen. We need to be realistic about what makes sense. You go to those below 2% levels of the Fed funds rate when the economy is in a major contraction, right? It's on the brink of a big recession. Then you have to cut rates aggressively to stimulate the economy. We are clearly not in that position. This is more of we've hit a stall speed maybe with the plane, and we're starting to descend, but very, very slowly. It's not plummeting. So, I think hopefully there remains independence at the Fed, and they follow what their dual mandate is, and not bow to political or public pressure, frankly, either direction. They need to do the right thing for what's right for the economy.
Yeah, I would agree, because I'm from the school that, having a healthy interest rate's good for the financial system. It's good for the consumer. It keeps everybody in check. It keeps you from borrowing too much. So it sort of levels the playing field. So, well, Glenn, believe it or not, it's time for a break already. We didn't even get into the equities yet, but I think we gave bonds their fair due. So we'll be back after this break. This is Leo Daprile. This is the Gem Young Wealthcast.
Planning for your future simple by offering both insurance and wealth management under one roof. Our team helps protect what matters most while guiding you toward your financial goals, whether it's safeguarding your home, health, business, or planning for a work-optional lifestyle. With everything in one place, you get seamless support, personalized strategies, and peace of mind. Call Gem Young Insurance and Wealth Advisors at 330-533-7941 today to schedule your fit meeting and experience all-in-one protection and planning.
At Gem Young Insurance and Wealth Advisors, we know insurance can feel complicated and overwhelming. That's why our team is here to listen, understand your unique situation, and provide solutions that work for you. From home and auto to life, plus a team dedicated just to commercial insurance, we help protect what matters most without the stress. Don't wait until an issue arises. Call Gem Young Insurance and Wealth Advisors at 330-533-7941 to schedule your fit meeting and get the protection you need today.
At Gem Young Insurance and Wealth Advisors, we believe your financial goals deserve more than just a plan. They deserve a team. From planning for a work-optional lifestyle to managing risk and supporting your everyday needs. Our financial planners, paraplanners, and service team work together to build a strategy that truly fits your life. Planning for the future? We'll help you make that confident financial decisions and achieve lasting peace of mind. Call Gem Young Insurance and Wealth Advisors today, 330-533-6936, to schedule your fit meeting and start building your financial future.
Now, back to the Gem Young Wealthcast, brought to you by Gem Young Insurance and Wealth Advisors. Once again, here's Leo Daprile.
Welcome back to the Gem Young Wealthcast. This is Leo Daprile. If you're just joining me today, I have with me Glenn Dorsey. He's the Senior Vice President of Portfolio Management at one of our esteemed firms, Clark Capital Management Group. Hey, Glenn, how are you?
I'm well, Leo. How are you?
Good. So just want to let people know that we've kicked off our video podcast, and we have a YouTube channel now. So you can just go to YouTube and just type in the Gem Young Wealthcast, and we're going to be there. For us to view, for Glenn, for our compliance departments to view. Anybody that wants to look at it can take a peek at it to make sure that we're on the up and up with things, right? So also, we're still a podcast, so you can download us anywhere you get your podcast. So start at the iHeartMedia app, Apple, wherever. Just track us down, look for Leo Daprile or the Gem Young Wealthcast. Pretty easy to find us these days. We're getting quite a reputation, Glenn. So before the break, we had a nice conversation about bonds and how they're back to being meaningful within a portfolio and providing meaningful return for the more conservative investor or the investor looking for income. And where 5 years ago, this was not a conversation we were having. So let's let's finish that conversation. I want to finish that for the 26 trends of where you see things. And what your thoughts are as a management group, leadership group, on where you think any strategy changes you guys might be thinking about in the fixed income space, and then we'll move on to the equity space.
Well, I think what we expect to happen in terms of interest rates during the year is that shorter term rates are going to continue to come down, and intermediate and longer term rates aren't going to move down as much. And the reason for that is the Federal Reserve controls the Fed funds rate, which is overnight lending between banks, so very short term. And when we saw this play out this year, or 2025, actually, short rates came down quite a bit and longer term rates did not. So where we had been positioned with the portfolio is kind of what we would call a barbell, where we had a slug of maturities in the kind of 1 to 2 year range, right, that were benefiting from those higher short rates. And then we would kind of skip the middle part of the curve and go out, call it, 5 to 8 years. As shorter rates come down, that's going to kind of make us want to move a little bit further out the curve to maintain the yield in the portfolio, because the artificially high short-term rates, because of where the Fed was and where inflation was, that's going away, right? So the money that's parked in CDs and T-bills that for the fixed income portfolio, you need to start to think about moving a little bit further out to kind of capture that yield and lock it in as the Fed lowers rates.
Okay. So still taking a very active position in fixed income, still being a meaningful part of people's portfolios. So that's good to hear. All right, so let's go back to Q4 of 25. I think we performed pretty strong considering the prior 3 quarters in the volatility we had during the year. And one of my concerns, and I kind of saw it a little bit happen, and my son Steven and I, when he's one of my analysts that we did in the third quarter, I said my fear is, and I was talking specifically about the tech sector, that it was perfectly priced, that the bar was so high for the tech companies that I didn't think there was much more room for them to grow in the fourth quarter. And maybe this was an opportunity for other companies, for instance, in the S&P 500, to kind of spread their wings a little bit. And that's kind of what happened, kind of how it played out and kind of what I saw. And that's just from doing this for so long. You just look at it and say, it goes back to the dot-com bubble, back in those eras to me, where everything was so perfect that you just can't keep doing perfect. That's just not the world we live in. So I think where they're landing now, and we haven't seen wild growth yet. So do you think, so that's not a recession. That's just, in my opinion, just a healthy sector price correction, right?
Yeah, so we divide the S&P 500 into the Magnificent Seven and then the S&P 493.
Right.
So for much of last year, it was just the Magnificent Seven show, and what we saw in the fourth quarter, I think, is a healthy rotation from just Magnificent Seven, which had become a really concentrated part of the S&P 500, to acknowledge that the other 493 companies are actually doing pretty well too. We're seeing their earnings, operating earnings, moving up in terms of the growth rates, Magnificent Seven earnings rate is moving down, still at a very high growth rate level, but it's moving down somewhat. So the 493 are a lot cheaper than the Magnificent Seven, right? So there's an opportunity there. We don't think that you need a major correction necessarily in the Magnificent Seven, but have the stock prices go up less than their earnings for a little bit, and that brings the multiple down somewhat. And conversely, you might see the opposite happen with the 493, right? And they're starting to play catch up. Value outperformed growth for the fourth quarter, which hasn't happened a whole heck of a lot in recent years either. I think it's a healthy rotation for the market. We get concerned when the market is dominated by a handful of companies. They're good companies. They have good growth rates. They're in exciting areas. But you're right. That was acknowledged in their PE ratios, right? They were not cheap.
So 2 areas that I'm starting to see some changes in trend. One of the things I follow closely is housing and the price of housing and the inventory of housing. And I'm seeing more of a moderation in terms of the buy side and sell side in housing. And I'm starting to see prices come down in many of the major markets for housing. So, but I'm also starting to see, and I'll give you another example here. I was reading an article in my local paper lately, Glenn, that there's a local community that put a moratorium on new data centers in their community. And part of the pushback is, and one of the things I didn't realize, there's 200 data centers in Ohio. Didn't know that, which is a lot. And they're wanting to build more. And I think it's just because of where we're located centrally. And the reason they're putting the moratorium on it is the residents are more concerned about, do we have the energy supply to power these? So, and I see a trend of, with the increase in energy costs, and is that going to start rising more to inflation? And then how does that come back and bite the consumer in a sector that maybe nobody's thinking about right now? But I see that being more of an issue in the next year or two.
Yeah, you're 100% right. There is not enough power to power all of the data centers that are being built, right? So what that ultimately does is creates more of a drain on the power generation and transmission system. They're going to need to expand, which means they apply for higher rates to consumers. All of that is likely to happen, and we are seeing that to some degree. Probably gets worse before it gets better. So all these companies are trying to explore different ways to bring power to the data centers. They're reopening nuclear facilities, right? They're going to try everything that they possibly can to get power cheaply to supply the energy needs of the data centers, which is tremendous. I mean, they're a big drain on the resources. So you're right to be cautious about it. The consumers are right to be cautious about it, because it's a thing. So
we've had 3 great years. The equity markets, 3 great years, which is unusual. And now we're talking, and I'm starting to get a consensus that, me, and even though I'm on Optimist Island at times, I'm always looking under the bed for the boogeyman too, right? And I'm still trying to find that, and I'm not fine. I have some pockets of concern, like housing moderating, which I think ultimately is good, and I think energy prices going up is a concern. I see what I'll call my sector recessions, and I think the restaurant game's been sort of in a recession for several years now. But in terms of big macro fears of what can transpire, I'm not really seeing them. Where are you landing on this?
Similar, which always makes me nervous when it's harder to identify where the problems are. I think the headwinds that we potentially face in 2026, right? Valuations aren't cheap. That doesn't mean you need a big correction, but that's a headwind for the market, offset by earnings growth that is accelerating. Operating earnings for the S&P 500 increased by about 13% in 2025, projected to increase 18% in 2026. And those numbers have been moving up recently. So we're just about to enter the fourth quarter earnings reporting season, and we'll get a good sense of whether those numbers are going to continue to go up. But valuation is definitely a headwind. Fed policy, whether it's too loose or too restrictive, is a concern. We need to keep an eye on the labor market to make sure that it is just a normal softening and not the beginning of something more severe. We don't think so. You keep an eye on the delinquency rates and be thoughtful about, where the credit risks are in the world. But right now, the macro fundamentals look good, because if you think about, again, just take a step back, take all the stock prices out of the equation and indexes and all these fancy things. What drives the value of a business? How much money it makes, right? So if these companies are going to continue to make more money over time, you would expect the values of those stocks and those businesses to go up. And that's what we've seen. By and large, we've had 3 great years because we've had 3 really great years of earnings. That's the key. We need to keep a hyper focus on that. When there's any cracks in that, that's when we're going to start to worry, and that's when you'll start to see the credit spreads widen and earnings estimates come down, and then valuations become too high in that environment. It doesn't matter what they are. When they start to deteriorate, earnings start to deteriorate, the multiple's always too high.
Right. So, and I see businesses, the way they're run today is so much different that the textbook reasons for a recession just don't seem to be there anymore. The oversupply, the overproduction, the over-hiring. Everybody seems quarter to quarter to constantly be worrying about the way these companies run, that there's such smoothness to it, and they seem to be so reactive to changes in their demand that they're making almost real-time changes to production, product distribution, things like that. So I think that's part of the reason we've been so efficient for the last 3 years is I think 2008 and 2009, a lot of lessons were learned. And I think in 2020 and 2021, with where we had too much production in 08 and 09, right? Because of everybody was being so optimistic. And then in 20 and 21, the just-in-time manufacturing really showed us the flaws to that. From 2008 and 2009 to 2020, just-in-time manufacturing looked ideal till we had an issue, and then we realized where all the flaws are in it. So I think we're moderating somewhere in between with companies making products around the world instead of maybe with just one spot, like, for instance, China, to have more stability to their distribution channel. So I think companies are run a lot more smarter than they were.
Yeah, I think the inventory cycle is going to put way less of a drag on the economic cycle, right? It always exacerbated the economic cycle because, you said, companies would manufacture too much, and then they would slow down production dramatically, and then the economy would slow. I think the cycle's still going to exist, but they are way better at managing those inventory cycles now. I would contend that 2008 and 2009 was an issue of the money inventory cycle, right? It was a product of interest rates that were bank lending standards that were non-existent, right? You had an environment where remember the no document loans, don't verify my income. I'm only going to put 5% down, and then I'm going to take a home equity line of credit for 10%. So I've got negative equity in my house. Who wouldn't buy a house? Right? And that's what led up to the unwinding of the financial crisis. Because remember back then, we saw, I think oil got up to around $150 a barrel in 2000 going into 2007. So you had consumer that was buying a house they shouldn't have ever been lent money to buy. You had costs going through the roof, and then it started to become this domino effect, right? And so that, I think 2008 and 2009, that cycle was more created by the financial services industry than anything else. But you're right. The more recent event, I think, actually shows how good companies have become at managing inventories. When you think about the global pandemic and production shut down, pretty much around the world, and how great a job companies did getting that rerouted and figured out and got that supply chain back up. At the worst part, if you went into a Home Depot store, you couldn't buy a garden hose. There was nothing on the shelves, right? And in pretty short order, they got things back. All the companies got inventory back up. So I do think we're a lot better at managing the inventory cycle, but it will still exist.
I think people are still using their paper products, Glenn, from 2020 that they bought that they're afraid they'd never see again.
That could be true.
That was
there was some hoarding going on.
that was the part of the whole thing that just made me laugh at the time. I'm like, how crazy people were. I get FORO, but man, it just took some people over the edge. Are you expecting the year to be bumpy?
Yes. So last year, we kind of had below normal volatility. We did have just shy of a 20% correction, and then we had another 5% correction during the year. Usually get 5% corrections or more per year. We had 55 days where the market moved by 1% or more either direction. 29 of them were down, 26 of them were up. Normal year 65. So we had, believe it or not, we had lower volatility last year than normal. This year, we have new Fed chair. Historically speaking, the market tests the new Fed chair, and we usually have some sort of a pullback after they take their office. Secondly, it's a midterm election year. That's if you look at a 4-year presidential cycle and look at returns for the stock market, the midterm election year is the worst of the 4 years for stocks. Generally speaking, you have a correction in call it spring to early fall, and then the market starts to rally before the election happens, and then the next year, the third year, is the best of the 4 years. Right? So election cycle stuff, new Fed chair, market priced for not quite perfection, but priced for pretty good execution. A lot of geopolitical risk, obviously, out there. We never know quite where it's going to pop up, but it pops up. So I would expect more normal volatility than we saw last year. But volatility isn't necessarily bad. Bumpy isn't necessarily bad. When you have a disciplined approach to finding good companies, if they're going to continue to operate at a high level and make more money, if the stock price goes down, that's an opportunity, right? We worry when earnings are going down and stock prices are going down. That's a different situation. But as long as earnings continue to move forward, any pullbacks in the market should be relatively short and shallow, and would, to us, create an opportunity for the longer term in terms of finding a good, high quality companies, business momentum, and then at a better valuation when the prices are lower.
And that's what's key with having the value strategy. So when you're in that value strategy, you're always looking for those opportunities. And for a lot of the more conservative investors, the value strategy seems to fit with them better because it kind of chops off the highs and the lows of being in an equity position. So, and that's really important through all of that. So, I think that's a very realistic perspective, Glenn, and I think people need to know that, because part of what I like to do, especially in this first quarter of the year, is help people manage expectations. Because sometimes we remember last year and then that becomes our hope of the next year. And that's rarely the case, if ever the case, right? So where do you guys see the indexes? I mean, where are you projecting things to finish at the end of the year? What kind of, are we back to single digit growth rates, I guess is what I'm getting at?
Well, I would, we have our 2026 market outlook call next week, where we'll launch our official price targets. But again, if you look at kind of where valuations are, what earnings expectations are for the end of this year, and then forecast even for 2027, it could argue for kind of call it a lower double digit end of year number with a lot of choppiness in between.
Okay, that's kind of where I'm seeing things too, because we're still priced a little healthy, and we still have to earn into that. So if I see anything, I don't see a recession coming either, but I do see some price corrections within a bull market coming, and I think that's where we're going to get the volatility for this year is kind of the trend. So that's one of the reasons I wanted to have that conversation with you, just to get your take on it. Sounds like we're aligned on how we think about that. So overall, what do you see going in the fixed income market? You kind of landing the same way? More, is that more realistically more of 25 going into 26?
Yeah, I think 2026 from the bond market side of the equation probably looks a fair amount like 2025. Right, we're going to have probably a few rate cuts. We have inflation continuing to trend the right way, so we should see a kind of a drifting down of rates over time. A more accelerated decline in shorter term maturity rates. So, the 1 month and 6 month and 1 year type maturities, those yields are going to come down more dramatically. But it's a year. We think it's probably a year of clipping coupon and then getting a little bit of price appreciation because interest rates go down. So, all in all, between stocks and bonds, a relatively healthy fundamental backdrop. If you have an environment where earnings are increasing and the Federal Reserve is cutting rates and interest rates in general are going down, that's historically been a pretty good combination for both stock and bond returns.
Okay. And staying true to disciplines. I think that's the other message I want our listeners to have is, wherever the market's going up or down, stay with your discipline, stay within your risk tolerance, kind of stay within the lane that makes you comfortable. Just because things have been good, you know how it is, people start wanting to get to the other return. And sometimes we're counseling our clients and saying, you're in this risk category because that's where you live and that's where you're happy. And sometimes when you're in a good market, you feel like you lost out on something. And I remind them that we're going to have another correction or a down market sometime, just don't know when. And that's when you'll go, I'm glad I didn't take that extra step. So even though things are hot and things are kind of fun right now, that's probably my parting word. Stay true to your discipline in 26.
Absolutely. Changing your investment risk profile because of last year's returns is really not a great idea.
Right.
It's staying focused on what you're trying to accomplish with your money, the amount of volatility you're willing to accept to get there. Because while stocks have a better return over the long term, they also have a heck of a lot more volatility than bonds. And for golfers, the analogy I use is stocks are a driver and bonds are a putter.
That's right.
You're going to hit it a lot further with a driver, but you can hit it a lot further left and right as well. So you have to be willing to accept those differences in terms of when you're building your portfolio.
Awesome. Well, Glenn, thank you. Believe it or not, we're out of time again. I want to thank you, Glenn Dorsey, Senior Vice President of Client Portfolio Management at Clark Capital Management Group. Glenn, thanks. I'll talk to you soon.
All right. Thank you, Leo.
Okay, this is Leo Daprile. This is the Gem Young Wealthcast. We'll be back after this break.
At Gem Young Insurance and Wealth Advisors, we know every financial journey is unique. That's why our team of financial planners, paraplanners, and service professionals work together to provide personalized strategies for a work-optional lifestyle, investments, and risk management. We're here to help you plan for today, protect tomorrow, and enjoy the life you've worked so hard for. Take the first step toward financial confidence. Call Gem Young Insurance and Wealth Advisors at 330-533-6936 to schedule your fit meeting today.
Hey, it's Medicare Jer here from Gem Young Insurance and Wealth Advisors. Medicare can feel confusing, but I'm here to make it simple. With the right Medicare Advantage or supplement plan, you can worry less about unexpected healthcare costs and focus more on enjoying life. Let's make sure you've got the coverage that fits your needs and gives you peace of mind. Call me, Medicare Jer, at Gem Young Insurance and Wealth Advisors today at 330-533-7941 to schedule your appointment, and let's get your plan in place.
By calling this number, you will be speaking to a licensed insurance agent to answer your questions or provide additional information about Medicare Advantage plans, prescription drug plans, or Medicare supplement insurance plans. This is an advertisement for insurance.
At Gem Young Insurance and Wealth Advisors, we make planning for your future simple by offering both insurance and wealth management under one roof. Our team helps protect what matters most while guiding you toward your financial goals, whether it's safeguarding your home, health, business, or planning for a work-optional lifestyle. With everything in one place, you get seamless support, personalized strategies, and peace of mind. Call Gem Young Insurance and Wealth Advisors at 330-533-7941 today to schedule your fit meeting and experience all-in-one protection and planning.
Now, back to the Gem Young Wealthcast, brought to you by Gem Young Insurance and Wealth Advisors. Once again, here's Leo Daprile.
Welcome back to the Gem Young Wealthcast. This is Leo Daprile. Well, as always with Glenn, it's a great show. We get a lot of great insight from him. And the burning question that my clients are asking me now is, Leo, will this continue? We've had 3 strong years. What's ahead for us? Should we start making portfolio changes? So that's why I wanted to bring up the point of saying, let's stick with our disciplines. You know, here at Gem Young Wealth Advisors, it's not just a market-based portfolio. We never build our client portfolios that way. We build them that's custom for you, because we need to not only help you achieve your goals, but we need to help protect you sometimes emotionally when we go through market corrections. So that's where this is so important. And again, if you're a regular listener to the show, you can appreciate Glenn's insight and everything that he provides. He's got a lot of data. He's got a smart team. We talk about that a lot, and he always comes prepared to really help us break through all the data that's out there and formulate some plans and strategies. So if you're a do-it-yourself investor, I hope this helped you a little bit, give you some more professional advice. I know anywhere you look, there's data available for you to try to make decisions, but the nuance of how portfolios are built and managed is what really matters, and that's where we're different, and that's the things we put together for our clients that are different so that they can appreciate a portfolio that's more custom to them. Because we do that, we find that our clients are much more comfortable with the strategies because, we're not just a build it, leave it alone sort of shop. We're constantly managing our client portfolios, constantly making changes as things go on. So it's very dynamic in the way we think and how we operate because at the end of the day, if you're still working, the aspirations for that work optional lifestyle, isn't it? That's what we're trying to get you to. If you're already past that and you're living your retirement years or that second career or just the choices that you're wanting to make during that time, that you're having the money and the cash to live that life on your terms. With the market performance the way it's been the last 3 years, we're actually starting to have different conversations. We're going to talk about more of that with some of our clients in March, that we're getting to the point with clients have been so successful with what we've been able to do for them that we're having conversations about legacy planning because many of them are getting to a point that they never thought they'd get to where they're actually not going to be spending the money they have. So that's a good problem that we've helped a lot of people create. So if there's any questions you have, please feel free to give us a call, set up that fit meeting. We'd love to talk to you. I appreciate you listening this morning. This is Leo Daprile. This is the Gem Young Wealthcast. And until next time.
Insurance and Wealth Advisors, we make planning for your future simple by offering both insurance and wealth management under one roof. Our team helps protect what matters most while guiding you toward your financial goals, whether it's safeguarding your home, health, business, or planning for a work-optional lifestyle. With everything in one place, you get seamless support, personalized strategies, and peace of mind. Call Gem Young Insurance and Wealth Advisors at 330-533-7941 today to schedule your fit meeting and experience all-in-one protection and planning.
At Gem Young Insurance and Wealth Advisors, we know insurance can feel complicated and overwhelming. That's why our team is here to listen, understand your unique situation, and provide solutions that work for you. From home and auto to life, plus a team dedicated just to commercial insurance, we help protect what matters most without the stress. Don't wait until an issue arises. Call Gem Young Insurance and Wealth Advisors at 330-533-7941 to schedule your fit meeting and get the protection you need today.
At Gem Young Insurance and Wealth Advisors, we believe your financial goals deserve more than just a plan. They deserve a team. From planning for a work-optional lifestyle to managing risk and supporting your everyday needs. Our financial planners, paraplanners, and service team work together to build a strategy that truly fits your life. Planning for the future? We'll help you make that confident financial decisions and achieve lasting peace of mind. Call Gem Young Insurance and Wealth Advisors today, 330-533-6936, to schedule your fit meeting and start building your financial future.
Join me every week where we talk anything and everything about your money. Have a topic you want to hear more about? Email Katie, that's Kayti, at gemyoung.com. You can find us on Apple, Spotify, and the iHeartRadio apps. Until next time, this is Leo Daprile.